If you walked into a busy suburban casual dining restaurant tonight, you would probably see a familiar sight. Families sharing appetizers, birthday parties cheering over dessert, and waitstaff rushing between tables. The parking lot is full. The kitchen is hot. To the untrained eye, business is booming, but behind the scenes, this restaurant is already dead. The eviction notice has already been drafted. The bankruptcy lawyers have already carved up the carcass, and the staff preparing your meal have no idea that this shift is their last. This is the great American restaurant collapse, and it is not happening because people stopped eating out. Since March of this year, an estimated 16,000 restaurants across the United States have quietly, permanently turned off their grills. We are told a convenient, comforting story about why this is happening. The corporate press points to inflation, rising beef prices, or a sudden, mysterious shift in consumer tastes. They blame workers demanding a living wage, claiming that $20 an hour for a line cook is an unsustainable luxury that breaks the back of the service industry. It is a neat, tidy narrative that places the blame on macroeconomic weather or the working class. It is also a complete lie. The reality is far more calculated, far more sinister, and infinitely more frustrating. The casual dining and fast food landscapes are not eroding due to natural economic cycles. They are being systematically dismantled from the inside out by a highly sophisticated, predatory financial machine. We are witnessing the final stage of a multi-decade experiment in financial engineering, where restaurants are no longer treated as places that serve food, but as real estate plays, debt delivery mechanisms, and tax write-offs for private equity firms. Consider the ultimate paradox of the modern economy. Demand for dining out has rarely been higher, yet the businesses satisfying that demand are dropping like flies. How does a business with a line out the door, generating millions of dollars in top-line revenue, suddenly find itself unable to pay for its own napkins? The answer lies in a financial magic trick called the sale-leaseback. It is a maneuver so cynical it should be illegal, yet it is the standard operating procedure for the Wall Street firms that have quietly bought up your favorite childhood chains. The trick works like this. A private equity firm buys a historic restaurant chain. They look at the balance sheet and realize the most valuable asset isn't the recipe for the biscuits or the loyalty of the customers. It is the dirt the restaurants sit on, so they sell the land. They sell every single building, every parking lot, and every prime piece of commercial real estate the chain spent 50 years paying off. They pocket the cash, distributing massive dividends to their investors. Then, they force the restaurant chain to lease back those very same buildings. Overnight, a company that had zero rent obligations is saddled with millions of dollars in permanent, unrenegotiable monthly lease payments. The cash is gone, the real estate is gone, and the rent clock is ticking. The restaurant is now a tenant in its own home, paying rent to a landlord that engineered its dependency. This is not a conspiracy theory. It is the exact blueprint that liquidated some of the most iconic names in American dining. And the collateral damage of this financial alchemy is measured in human lives. Tens of thousands of cooks, servers, and managers are showing up to work only to find padlocks on the doors and corporate phone lines disconnected. No severance, no warning, just a laminated sign on a glass door telling them to go home. We are going to peel back the grease-stained curtain of the modern food industry. We will look at 15 major chains that are currently shrinking, decaying, or preparing for total liquidation. We will expose the hidden mechanisms, the predatory leases, the artificial intelligence schemes designed to gouge your wallet, and the boardroom decisions that traded long-term survival for short-term stock buybacks. Because what is happening to the American restaurant is not an isolated crisis, it is a warning sign. It is a demonstration of what happens when the physical spaces of our communities are financialized to the absolute limit. And at the center of this collapse is a single devastating question. When the financial engineers are done extracting every cent of value from the places we eat, what, if anything, will be left? To understand how we arrived at this breaking point, we have to look past the empty dining rooms of today and trace the roots of a geographic and economic trap that was set decades ago. A trap built on cheap credit, reckless expansion, and a fundamental misunderstanding of what a restaurant actually is. The crisis currently hollowing out American dining rooms did not begin with the economic shocks of the 2020s. nor is it a simple byproduct of rising food costs. To find the true origin of this collapse, we have to look back to a series of deliberate post-war structural choices that transformed the American landscape, followed by a massive wave of deregulation and financial engineering in the late 1990s and early 2000s. During the mid to late 20th century, the United States embarked on an unprecedented suburban development boom. Built entirely around car dependency, this expansion required a specific kind of commercial infrastructure: the strip mall, the suburban power center, and the standalone highway-adjacent retail pad. Developers did not build these spaces to be unique communities. They built them to act as predictable, high-yield financial assets. To secure the massive bank loans needed to construct these sprawling commercial developments, real estate firms needed tenants with pristine credit ratings, who could sign long-term commitments. Fast food franchises and national casual dining chains became the perfect anchor tenants. This physical expansion created a geographic trap. Between 1990 and 2015, the rate of restaurant expansion in the United States vastly outpaced population growth. By the mid-2010s, the country was severely overstored, possessing more retail and restaurant square footage per capita than any other nation on Earth. Chains like Subway, Quiznos, and Applebee's raced to open locations directly across the street from their own existing units, cannibalizing their own customer bases in a desperate bid to show Wall Street constant quarterly unit growth. While this spatial saturation was quietly building a structural fragile ecosystem, a major shift in the American tax code and financial markets set the trap. In 1960, Congress passed the Real Estate Investment Trust Act, creating REITs to allow individual investors to buy shares in commercial real estate portfolios. For decades, these trusts operated relatively quietly. However, the Taxpayer Relief Act of 1997 dramatically altered the landscape by making it far easier and more tax advantageous for corporations to spin off their real estate holdings into independent REITs without triggering massive capital gains taxes. This legislative shift turned real estate from an operational necessity into a highly tradable financial product. Prior to this, iconic dining name brands like Red Lobster, Bob Evans, and Jack in the Box owned the physical dirt and buildings beneath their kitchens. This real estate acted as an economic shock absorber. If a restaurant had a bad quarter, or if the economy slipped into a recession, the business survived because it did not owe rent. Its physical footprint was fully paid off, providing a secure foundation that allowed management to ride out temporary operational storms. That security vanished when private equity firms recognized a massive unexploited arbitrage opportunity. Following the 2008 financial crisis, the Federal Reserve cut interest rates to near zero, embarking on a decade-long period of historically cheap credit. This zero interest rate policy, or ZARP, created a mountain of cheap cash that private equity groups needed to deploy. They targeted the restaurant sector, utilizing an aggressive investment strategy known as the leverage buyout. In a standard leverage buyout, a private equity firm does not buy a restaurant chain using its own cash. Instead, it borrows up to 90% of the purchase price, using the target restaurant's own assets and real estate as collateral for the loan. Once the acquisition is finalized, the massive debt load is transferred directly onto the balance sheet of the acquired restaurant chain. The restaurant is now legally responsible for paying back the loan that was used to purchase it. To immediately recoup their equity and pay down a portion of this newly acquired debt, private equity owners immediately turn to the sale-leaseback transaction. They sell the physical properties owned by the restaurant chain to a specialized net lease REIT. The REIT buys the land for hundreds of millions of dollars, and in return, the restaurant chain signs a 20-year triple net lease. The triple net lease, commonly referred to as an NNN lease, is the ultimate structural landmine in commercial real estate. Under a standard lease, a landlord is responsible for major structural repairs, property taxes, and building insurance. Under an NNN lease, all of these financial obligations are transferred entirely to the tenant. The restaurant chain must pay a fixed base rent, which typically escalates by 1 to 3% every single year, while also absorbing 100% of the property taxes, building insurance, and structural maintenance costs For the landlord, the NNN lease represents what Wall Street calls moix of money, a completely passive, guaranteed income stream that behaves exactly like a corporate bond. For the restaurant, however, it represents an operational gravity well, a location that once operated with thin but stable profit margins is suddenly saddled with a massive, permanent fixed cost that remains completely unchanged regardless of whether the restaurant is empty or full. This financial playbook was executed with devastating precision across the casual dining sector. When Golden Gate Capital acquired Red Lobster from Darden Restaurants in 2014 for $2.1 billion, they immediately executed a $1.5 billion sale-leaseback of the chain's real estate portfolio. On paper, the transaction was heralded as a brilliant unlocking of trapped value. In reality, it permanently stripped Red Lobster of its most valuable asset, replacing it with an annual rent obligation of nearly $190 million. The chain went from a position of absolute geographic and financial stability to a state of permanent, high-wire vulnerability. The structural trap was now set. By the end of the 2010s, hundreds of American restaurant chains were operating on a razor's edge. Their menus were identical, their geographic locations were oversaturated, their corporate parent companies were buried under billions of dollars of high-interest acquisition debt, and their physical spaces were leased under long-term, escalating triple-net contracts. They had zero financial cushion left. When the macroeconomic environment finally shifted, these heavily leveraged, real estate-depleted brands did not just struggle. They began to collapse in a synchronized chain reaction. The structural trap constructed over decades of aggressive expansion and real estate liquidations finally collided with operational reality, triggering an unprecedented wave of corporate insolvencies, labor struggles, and legal battles. By the mid-2020s, the margin for error in the restaurant business had shrunk to zero. As interest rates remained elevated and consumer credit card debt climbed to historic highs, the fragile foundations of America's leveraged dining chains began to crack openly, exposing a bitter conflict between corporate boards, local franchise operators, and the working-class labor force. The most visible front of this war opened in California on April 1, 2024, with the implementation of Assembly Bill 1228. The legislation mandated a $20 an hour minimum wage for fast food workers employed by chains with 60 or more national locations. This regulatory shift immediately initiated a masterclass in corporate scapegoating and operational panic. National fast food conglomerates publicly warned of an impending restaurant apocalypse, claiming that the mandate would drive them out of business. Behind closed doors, however, the strategy was not to absorb the cost of labor through executive compensation adjustments or reduced stock buybacks, but to externalize the entire financial burden onto employees and consumers. In the months surrounding the law's implementation, major Pizza Hut franchise groups, including Pack Pizza and Southern California Pizza Company, filed worker adjustment notices indicating the immediate termination of over 1,200 in-house delivery drivers. These operators dismantled their internal delivery infrastructures, shifting the labor, vehicle costs, and liability entirely onto third-party gig platforms like DoorDash and Uber Eats. The immediate consequence was a sharp decline in service quality and a massive spike in consumer fees. Customers who once paid a flat delivery fee to a dedicated W-2 employee were suddenly forced to navigate a labyrinth of service charges, regulatory response fees, and tips, all while receiving cold food from independent contractors managing multiple orders across different platforms. This shift highlighted a deeper, more systemic conflict: the quiet cartelization of restaurant operations by third-party delivery applications. For years, platforms like DoorDash, Grubhub, and Uber Eats marketed themselves as supplementary revenue streams for struggling restaurants. In reality, they became high-priced gatekeepers. These platforms routinely extract commissions ranging from 15% to 30% on every order placed through their apps. Because casual dining and fast food profit margins typically hover between 5% and 15%, relying on third-party delivery is a mathematically unsustainable proposition. To survive, restaurants were forced to institute dual-tier pricing, inflating app-based menu items by 20% to 40% compared to in-store prices. By 2025, a consumer ordering a basic combo meal through an app was paying nearly double the cost of the actual food, creating a severe demand drop as middle-class household budgets contracted, while corporations blamed rising wages. The financial court records of bankrupt chains revealed a completely different culprit: catastrophic corporate mismanagement and franchisee exploitation. The ongoing civil war within the Subway franchise network serves as a primary case study. After its acquisition by the private equity giant Rock Capital, Subway Corporate launched an aggressive campaign to force its small business franchisees to purchase automated meat slicers, costing up to $6,000 per location. The mandate was marketed as a move to improve ingredient quality and freshness. In reality, it saddled already struggling store owners with hundreds of millions of dollars in collective capital expenditures, while doing nothing to address the declining foot traffic caused by consecutive years of menu price hikes. Subway's corporate structure allowed the parent company to collect royalties based on top-line revenue, meaning corporate profited even if individual franchise locations operated at a net loss. This extraction model pushed the casual dining sector into a historic bankruptcy cycle. On November 2, 2024, TGI Fridays officially filed for Chapter 11 bankruptcy protection. The court filings painted a devastating picture of a brand suffocating under the weight of its own capital structure. The chain reported assets and liabilities of between $100 million and $500 million. The filing followed years of desperate restructuring efforts, including the abrupt closure of dozens of underperforming locations and a failed, last-minute merger with its United Kingdom franchisee. TGI Fridays had succumbed to the same terminal diagnosis that claimed so many of its peers: a complete failure to modernize its operational model while carrying massive debt service obligations that devoured its daily cash flow. The collapse was not isolated. Denny's, an American diner icon, announced in late 2024 that it would permanently shutter 150 of its lowest-performing locations, representing roughly 10% of its entire domestic footprint. The company's leadership explicitly cited aging facilities and the inability of franchise partners to secure the high-interest loans required to complete mandatory corporate remodels. Buca di Beppo, the family-style Italian chain, filed for Chapter 11 in August 2024, listing over $40 million in debt. Court documents showed that the company was operating on such thin margins that a minor drop in group dining bookings during the post-holiday season was enough to trigger a liquidity crisis. These corporate failures have created a massive, quiet crisis for the commercial real estate sector. Every shuttered casual dining restaurant represents an empty, highly specialized 5,000 square foot building that is incredibly difficult to re-lease. These properties, often configured with custom commercial kitchens, grease traps, and unique architectural brand identifiers, sit vacant for months or years. As national chains default on their long-term triple net leases, the specialized REITs that bought these properties are facing their own write-downs, threatening the stability of the broader commercial, mortgage-backed securities market. The situation has reached a dead end. Corporations cannot lower prices because they must service their debt and escalating rent obligations. Consumers cannot pay higher prices because wages have not kept pace with inflation, and franchisees are caught in the middle, forced to choose between breaking their contracts or operating at a